portfolio manager at Argent Capital Management. Jed, we talk a lot about tech, but you say aerospace and defense is going to have a strong demand environment this year. But how much of that is priced in already?
Yeah, some of it is priced in. A lot of those stocks performed very well in 2025. One that didn't perform quite as well and trades at what we think is a reasonable valuation is TransDigm. TransDigm announced a sizable acquisition just last week, almost $1 billion. And we think all three of their end markets are firing at the same time. Commercial aerospace, new aircraft production and deliveries, aftermarket for both defense and aerospace, and then the defense, U.S. budget circumstance, which remains strong, double-digit growth this year. So we like that stock quite a bit.
You also like retail at scale, and for that, Amazon. What about Walmart? What about Costco? Why, in particular, the Amazon call, and how much is the consumer's health, particularly the working-class consumer, at play?
Yeah, big is winning in U.S. retail. That's kind of the big headline for us. That means Amazon, Costco, and Walmart, the three biggest U.S. retailers, they're outgrowing pretty much everyone else. Most of the retail sales growth nationwide is being gobbled up by those three. We expect that to continue. Walmart in particular has benefited from consumer trade down activity over the last couple of years, but also the strongest growing customer segment for them is the high-end consumer. So Walmart, very well positioned. That stock has done very well. It's at almost 40 times next 12 months earnings, which is a 10-year high for that stock. We've seen Costco's valuation come down from almost 50 times to near Walmart's 40 times today. So those stocks are priced almost at parity with each other. They're both growing mid-single digits. We like Amazon the most because it's growing 11, 12% a year, faster than the previous two I mentioned. And I think they're widening their distribution advantage over peers with the heavy investment in in robotics within their warehouses, and then also their warehouse expansion to rural areas, we think driving additional growth.
Yeah, autonomy on factory floors and in warehouses and the like, perhaps going to be an even bigger story to your point here in 2026. Jed, if I just take a step back here, we had 3 straight years of double-digit percentage gains for the S&P. You think this could be the 4th year where we see something like that again? How? Why?
Yeah, the short answer is double-digit corporate earnings growth. I think the S&P 500 is expected to grow its earnings 14% in aggregate in 2026. That's led by tech, but with other areas of contribution as well, including industrials and financials. So that broad-based earnings growth is a big deal. The market will also benefit from falling interest rates. I think the Fed is a big swing factor in 2026. We'll get the new chair announcement probably here in the next couple weeks, taking a seat in May. And the tax bill is going to contribute some as well. And then finally, rising IPO activity, rising merger and acquisition activity should be helpful for markets as well.
What could go wrong? What are the biggest risks?
Inflation is a little sticky, a little bit higher than the Fed wants, probably restraining the pace of interest rate cuts. And I think some complain that valuation is too high. Valuation in particular doesn't bother me. I think the rising valuation over the last few years just reflects the increased profitability and growth prospects of the big tech companies that represent a bigger and bigger chunk of our major U.S. benchmarks.
Jed, what do you see as the biggest risks in the market, and where do midterms and the, historically shifting political environment play in? Normally, the party that's in control of the executive branch in both houses of Congress doesn't do quite as well at midterms.
Yeah, I think the biggest risk that I see in markets is that the AI infrastructure build out is increasingly financed by capital markets issuance, both equity and debt, rather than the very strong cash flows of the big hyperscalers that have done most of the spending thus far. We see companies like CoreWeave and Oracle needing to rely more on capital markets to make those AI investments. I think that's a risk because capital markets are inherently risky and volatile. As far as the midterm elections, I see that impacting the equity market most in the healthcare industry, hospitals and other provider groups, the health insurance companies, their earnings and business prospects really depend on the regulatory environment. The Biden administration was fairly tough in most of those areas. The Trump administration has eased up a bit, but we may see, a shift back to Democrat control or at least balanced environment, starting in 2027, depending on how these midterms go.